So I think about the last 3 months from a fixed income standpoint. 10-year Treasury yields bottomed at a yield of 1.45% on the 3rd of September, and since then those yields have been moving gradually higher. It's really been a combination of a few things. We've had a bit of better news around trade. Trade tensions between the US and China seem to be improving at the moment. At the same time, the economic data showing green shoots, having had a couple of years of declines. We're now seeing a bit of a better pickup there, and it looks like the global central banks are for the time being on hold after the significant easing that they've done over the course of this year. What it's meant for the fund and the ETF is that we've delivered positive returns over that period, whereas if you look at, say, a Bloomberg Barclays global aggregate index, you're down close to 1% over the last few months. The headline duration on the fund and the ETF is currently around about 4 years, and the asset allocation mix is broadly diversified between high yield credit, investment grade credit, securitized bonds, emerging market bonds, and developed market governments. If I think about the fund and the ETF over the course of the year, we've actually been in risk reduction mode. Our high yield allocation has come down from around a third of the portfolio to around about 20% today. This really has been due to the strong performance that we've seen across the asset class. Spreads have come in close to the tights that we've seen since the financial crisis, and for us it makes sense to reduce risk and have the ability to go back into the asset class if and when volatility reappears. As we look forward into the first quarter of 2020, our base case, with a 55% probability, is that the global economy will grow at a sub-trend pace. On the one side, you have to acknowledge that we are late in the economic cycle, and that the trade tensions, although thawing between the US and China, are unlikely to go away completely. Yet at the same time, we've seen unprecedented easing over the course of this year from the global central banks, and the economic data, which had really been falling over the last couple of years from a global manufacturing PMI standpoint, has been recovering over the last few months. It's an environment where we see 10-year Treasury yields trading in a range, 1.5% to 2%, and that carry in your portfolio is going to be very important. The returns that we received for fixed income throughout 2019 are unlikely to be repeated. It's an environment where you are going to have a more active, more flexible fixed income portfolio to try to gather those returns that really our clients are after. Thank you for taking the time.